Hi, my name is Gary Mishuris. I'm the Managing Partner and Chief Investment Officer of Silver Ring Value Partners. We left off talking about the five-step research process, which is basically how do you look at a potential investment and estimate a range of values. So how do you do the due diligence on a potential investment? Now let's talk about what do you do with that information. So how do you make a decision to either buy that investment, or if and when the time comes and you bought the investment, how do you decide when to sell? So let's start with the buying. So I believe in having rigorous guidelines, and to some that might seem too rigid and it seems arbitrary to have these fixed cutoff points. And there can be a point to that, but I think what you gain is discipline and rigor to act rationally, especially under duress when the markets are moving quickly and there's maybe mental stress. You have a process that's rigorous and repeatable you can fall back on. And I think that's very important. So when we talked about the five-step research process, the output was the range of values for the business. So from worst case to best case, where the base case is the most likely scenario of what the business is worth. And also your quality assessment of how good of a business is it. And for the quality assessment, I use a scale of 1 to 5. And it's not because there's only 5 levels of quality, but just because, while it's a continuum, it's easier to map it to kind of 5 buckets of quality. And the best quality businesses are 1, an average business is a 3, and a terrible business is a 5. So first of all, I eliminate 4s and 5s. So below average and terrible businesses, they go out because I think it's really tough to value them. There are some value investors who feel anything is a good value at the right price. My counterpoint is that we don't know the value of everything, and you have to pass, and I try to avoid even starting to value below average businesses. So we're dealing really with a range of average, which means decent, to great. So that's kind of the range in terms of quality. And I have different cutoff points as far as purchasing an investment, and that's a function of that quality. So let's talk about that range. So for an average business, my threshold and the minimum I would want is for the stock to be no more than 55% of my base case value. So let's say I estimate the value of this pen is 100, and I think it's of average quality. I'm going to pay 55 or less if I'm going to buy this pen. So let's say that I think it's above average. Now my threshold is 65, so I want to pay no more than $65 on $100 of value for an above average business. And finally, let's say this is a great business. It's a great pen. It's worth 100. I'm willing to pay up to $75 for the $100 pen. So the idea is that the margin of safety, and the margin of safety is a very important concept where you're trying to make sure you have room for error, that you can be wrong and still either not lose money or still have a good return, even if you're somewhat off in your assumptions, that there's a margin of safety, and it comes from both the valuation work that you do, so the price to value gap, and that's what we're talking about here with these cutoff points, and also the quality of what you value. And because, as I talked about previously, the range of values and your chances of being right might be higher, so the chance of being right might be higher, and the range of values might be tighter for a great business versus an average business where the range might be wider. And so because that range is wider for an average business, you want to get a little bit more margin of safety in terms of the price to value ratio. So that's why those cutoff levels are different for each type of business. By the way, because I underwrite my value ranges with a 10% discount rate, what that translates into is, for the very best businesses, I wouldn't buy them if I didn't think that if I were to buy the whole business and own it forever, I wouldn't get at least a 12% rate of return. So that's my threshold. If it's not 12% at the highest level of company quality, I'm not interested. For that second tier of company quality, the above average business, that 65 cents on the dollar of base case value translates into about a 13 to 14 long-term rate of return. Again, if you own the whole business, never sell and just get the cash flow stream. And finally, for that average business, that 55% of value threshold translates into about a 15% annual rate of return. So you want a little bit more return for that little bit lower quality. You also, in my view, don't want to go too far down that quality spectrum, and you want to cut off the below average businesses. And in my case, what my sweet spot really is above average and great businesses. Occasionally there'll be some average businesses that are really cheap, but that's not the goal. That's more a function of the opportunity set. So that's the buy process. You're trying to decide, at least as far as whether you're going to buy or not. We'll talk about portfolio construction and position sizing later, but that's the process for deciding whether something meets the criteria for purchase based on our work. So with that, let's talk about selling, because selling is equally important, and I would argue that most value investors, including myself, don't do as good a job selling investments as they do buying them. And I think some of it makes sense because you're trying so hard to have enough margin of safety in your buy decision that you kind of think that takes care of everything. But so what are some reasons why you might want to sell an investment? Well, the happiest reason is that you bought something at a big discount to value. Let's use that second bucket for above average business. You bought it at 65% of what you think it's worth. So let's just say 65 cents on the dollar of value. And now that gap closed. The stock went from 65 to 100. It's now fully priced. So you're done. That's a great outcome. It worked out, and you're trying to be disciplined and you exit. There are a few nuances. So one nuance is that I think that rather than sell it all at once, I found it better to sell it in tranches. And what I typically do is, as a function of company quality, as the investment starts to approach that 100 cents on the dollar of full value, with respect to my base case value estimate, I start to reduce the position. So for an above average business, it might be selling a third at 90 cents on the dollar value, selling another third at 95 cents, and maybe selling the remaining third at 100. So, and the reason is that as the stock goes from deeply undervalued to close to fair value, your margin of safety erodes, right? And how much money you could potentially lose also erodes. And all else equal, assuming other investments in your portfolio haven't moved, the chances are this has become a bigger position by virtue of success as the stock or bond price goes up. So therefore, the risk you have is higher just as the margin of safety is lower. So I think it's okay as a value investor to leave some money on the table and sell a little bit before full value is realized, but not too much so. And that's why there's the sliding scale. So let's talk about another reason to sell, and that's opportunity cost. Let's say you deployed all your capital, you have no spare cash in the portfolio, and a great investment comes up, and it's really attractive. Well, it might be a better idea for you to take that new investment and replace some of your existing holdings. And so how do you decide that? I think you should have some gap in mind in terms of how much better should the new investment be than your worst current investment. Because if it's very close, I think swapping things in and out, especially given that you might not know the new investment as well, you have not followed it for as long, it's probably not the best idea. So I typically say for an equal quality business, I want that cents on the dollar, the price to value ratio, to be at least 20 cents better. So what I mean is, let's say I have a business that I bought at 65 cents on the dollar, and it's an above average business, and now it's 80 cents on the dollar. Well, my process doesn't tell me to sell it at 80 cents. I usually start reducing the position, as I talked about earlier, at 90 cents. But let's say now there is a great high quality business, an above average business, and it comes along and it's at 60 cents on the dollar. So that makes sense. I might want to sell at 80 cents if I don't have any cash and replace it with something that's at 60 cents. But let's say something comes along and it's at 70 cents, probably not. And then there's a little bit of an art. How do you compare an above average business that is at 80 cents versus a great or 1 out of 5 on my scale business that's at 70 cents? I think there's judgment. I think you have to look at other portfolio considerations as well. I think you could replace it or not. That's that area where I think you have to think about a specific situation, but it'd probably be fine either way. But that's another reason to sell is opportunity cost. You have better ideas replacing some of the ideas that are not as attractive as the new ideas. Another important consideration in terms of selling is, what if you're wrong? I think value investors frequently have a very static view of value. So they do this work, they say this pen is worth 100. Or let's use ranges because as we talked about value as a range, it's worth 50 to 150 with a base case of 100, that's our value range. Well, there's two things. Value is uncertain, that's why we use a range. Value also changes, right? So for instance, we might learn information that made us think we were wrong, and it's not 50 to 150 is not the right range. Maybe it's 25 to 75. That would be a big change, obviously, but that's just an extreme example. So you have to be open to that new information. You have to update that value range when warranted. The other possibility is that you were right at the time. The business was worth 50 to 150, but now the value's changed. Maybe they were successful in a business venture that was very nascent, but now it's proven out and it's generating a lot of cash flow. That example might be Amazon. Amazon launched AWS, which is a division where it basically has shared infrastructure for computer users, where people can rent time, or computing power, or storage. And that's not a business that existed for Amazon. It was just an online retailer. So you want to make sure you're open to, as the business value changes, you want to make sure that you're updating your value range. So I think the process works, meaning that you should be rigorous on your sell discipline, but you want to make sure that you're not behaviorally anchored to your initial conclusion, and that you're responsive to new information and new evidence, and update the value range, and then use those rigorous cutoffs. So to summarize, I think having rigor and having fixed cutoffs, while there are pros and cons, I think the pros outweigh the cons, and the pros are really the discipline and repeatability and the rigor it adds to your process. And I think you should use them both for buy and for sell decisions. I think that you also need to take into account quality, and so it's not all about cheapness or undervaluation. You also have to consider that other dimension of what you're getting and how good of a business it is. And I think you should err on selling the better businesses a bit later, and the more average businesses a little bit earlier. So that's buying and selling. And these are the rules we use for buying and selling. And I think it's very important to have this rigorous process for both of those decisions. And next, we'll talk about how much. How do you decide how to size the position in the portfolio?